You're listening to the Learn Like a CPA podcast, where we talk about all things real estate, tax strategy, and personal finance. Whether you're a real estate investor looking to scale your portfolio, or you're an individual wanting to take your financial freedom journey to the next level, this is a podcast for you. Welcome back, everyone, to the Learn Like a CPA show. I'm your host, Ryan Bakey. Today, we're going to be talking about retirement accounts. There's plenty of them out there. You have 401ks, whether it's traditional, Roth 401k, IRAs, such as traditional or Roth IRAs. You have SEP IRAs, simple IRAs, all these different types of retirement accounts that the government allows you to use to invest and save in your future. The problem is there's so many accounts out there, and I think this is by design. I mean, it's hard enough to get most Americans or people to invest, let alone just give them a vehicle to invest in. And if you ask me, we should just have one account, and you're able to put however much thousands of dollars in there per year, and then we should just call it, that's it. However, we have these very complex rules and regulations, but the best account out there by far is the solo 401k. The reason why your financial advisor doesn't sell you on the solo 401k is because they don't make any money from it. You can actually self-administer your solo 401k, unlike some of the other different types of retirement options. So who qualifies for a solo 401k? Well, self-employed people who run a business that has a net profit, right? You have to run a business that has a net profit at the end of the year. You can have a spouse be a part of your solo 401k if they work in the business. And you can actually have part-time employees, but they cannot work more than 1,000 hours a year. Shout out to Matt Sorensen and Ignatius L. Jackson for letting me know about this, because I personally thought as soon as you have employees, then you are not eligible for the solo 401k. But it turns out you can have employees just so as long as they don't work at least 1,000 hours per year. You can still be working at a company. Maybe you're still W-2. As long as you have a side hustle, you're going to be able to contribute to this account. Keep in mind the total employee contribution. Okay, so as an employee across all your retirement accounts, across all the companies that you might work for in one given year, you're only allowed a max employee contribution, which in 2022, it's $20,500. And in 2023, the IRS just announced that they're actually raising it by $2,000. So in 2023, you'll be able to contribute up to $22,500 into your employee side of your contributions for your 401k. Now, this is important because let's say you quit your W-2 job halfway through the year and then you open up your own business. Well, that employee portion can only be the $20,500. And this actually happened to me last year where, I was going through a change where I quit my W-2, my job, and I also opened up a solo 401k. The max that I can contribute as an employee was that employee limit. What I like about the solo 401k the most is because you are the best employee in your business, right? You can do, not only can you do the same contribution that every other person can that works at a W-2, but you can also get a business deduction for the business contribution, right? So I'm able to contribute my employee contribution, $20,500, and I'm able to get a business deduction based on how much salary that I contribute to my account. Now, the thing is let's say I do the employee side, $20,500. So as an employee, I can do $20,500, and as a business, I can do 25% of my W-2 wages. So let's say I was to pay myself $50,000 as a W-2 for working in my company. I'd be able to pay myself 25% of the $50,000, which comes out to be about $12,500 in a business contribution that I get, in addition to the $20,000 that I'm able to do as an employee. So this is super powerful because not only can you get the employee limit, but you can also take advantage of getting the business contribution. And this business portion is actually a tax deduction from your business income because you're contributing to retirement accounts of your employees. It just so happens that your employee is you. I would recommend contributing to the business portion first because you'll get that deduction first. And then if you have room left over, then you go to your employee option. The total amount between these two accounts for 2022, you can actually have $1,000 total stashed away for retirement in these things. And this is why I like them so much, is because you can get so much more money into them. You're also able to roll old 401k plans into your sole 401k. So let's say you had a previous employer that had a 401k. Once you have your sole 401k set up, you're able to roll your funds into that account. And why you would want to do that is because of the flexibility. So some of the perks and the benefits of the sole 401k is you can actually borrow against it. And so you're able to take up to $50,000 from it at a time, and you pay it back at a prime rate plus 1 or 2% given your investment advisor. The strategy here is go ahead and contribute when you're at a 35 or 37% tax bracket, and then get your tax deduction, and then turn around and borrow against the value of the account, and you're able to get your tax deduction. You're able to use that money in your personal name, whether it's for your business, rental properties, etc. Why I like the sole 401k also is if you were ever to self-direct your sole 401k, it's not subject to UBIT or UDFI tax, which all your self-directed IRAs or other types of retirement investing in real estate is going to be subject to. This tax is at trust and estate rates, and it gets very high very quickly, to the point where if you make $10,000 in your retirement account using this type of tax or using leverage, you're paying 37% in taxes right away. Why I like it also too is you can generally administrate your account, and you get to pick what investments are in the account. So I'm able to invest in the same things that my Roth IRA or my taxable brokerage is invested in with inside of my sole 401k. And the cherry on top is the employee contribution can also be a Roth contribution. So you can do Roth employee contributions, and then your business deduction is going to always be traditional. Remember that business side is always traditional, which can be converted later on to Roth. So this is the most supercharged retirement account for people who are self-employed, and I recommend this over a SEP IRA, a simple IRA, and even some of the other retirement accounts. This one offers you the most flexibility. You can also stash the most amount of money into this account. So a few Q&As that we got, wanted to lump this together with some Q&As, is one of the talks was, how does the recession impact short-term rentals / buying properties? And I will say this, it depends on where you're at. A lot of short-term rental clients of mine and people in the industry are very scared right now because bookings are across the board down, as well as carrying costs are up. You know, it costs you more to heat your house, the electric, the gas, all those utilities are up and bookings are down. And so what I would say to that is hold on and make sure your cash reserves are boosted even more so than you normally have them to be able to weather the storm. On the multifamily side, things are a little bit more interesting because me personally, the last 2 or 3 offers that I put out on properties, we've had no competing offers. There's been nobody putting out offers on properties, which is very interesting because even though the interest rates are up, there's no competition right now. And so a lot of people are scared to enter the market to buy rental properties or to even buy a primary home, which means there's less competition. So if you can still find a deal even during this time, I would say go for it. There's going to be less competition. Again, the last 2 properties that I've bid on, no other offers, just because it seems like everybody's scared. The last question today is, can you do a cost segregation on a 1031 exchange property? The quick answer is yes, you can. The more detailed answer is you can, but you have to figure out how it's going to benefit you. You see, when you do a cost segregation on a property, and then you decide to, when you do a 1031 exchange on a property, your basis in that property is going to be generally your old basis in the previous property. So just to give you an example, if I bought a property for $100,000, and let's say it goes up to $500,000, and I have a capital gain here of $400,000, I 1031 exchange the entire thing into a new $500,000 property. Well, my basis in the new property is not $500,000, yet it's the carryover basis that I had originally of $100,000. So if I do a cost segregation on this property, I'm only going to get a benefit at $100,000, which in my opinion is not worth it. However, if let's say the same scenario here, you had a $100,000 property that's now worth $500,000, and you traded up and you took this $500,000 and you bought $1 million property. Well, your basis in the new property would be your carryover basis of 100 plus the new debt that you assumed, plus the new debt. So in this case, your basis would be the $100,000 plus the $500,000 worth of debt that you took on. And so in this scenario, your basis would be $600,000, which would therefore make it worth doing a cost segregation on the property that you 1031 into. A very complex topic, and do not navigate this alone. Work with a tax advisor to help you in this specific scenario. So that's it for today's episode, guys. We talked about solo 401k. We talked about who qualifies, the strategy behind it. We talked about the Roth or traditional options with the account. We talked about how does the recession impact short-term rental buying or purchases, as well as we talked about cost segregation studies on 1031 exchanges. If you like the show, please leave a review wherever you're listening, whether it's Spotify, Apple Music, YouTube, also on my website if you read the blog at learnlikeacpa.com. And if you want to get in contact with me, the best way possible is to just leave me a message on social media. Instagram, TikTok, at learnlikeacpa is where you can find me. Thanks, everybody. We'll see you guys in the next episode.